For months, it was the only thing the market could talk about, the Fed pivot. And then, in late 2025, it finally happened. The interest rate cuts began. But that massive, explosive stock market rally that everyone was banking on, yeah, it never really showed up. So what on earth really happened? I mean, this is the rule we all learn, right? It's investing 101. The Fed cuts rates, borrowing gets cheaper, the economy gets a nice little shot in the arm, and boom, the stock market is supposed to take off like a rocket. Simple, predictable, profitable. But what if this time it wasn't simple at all?
Because since that pivot finally got underway, the reality has been, well, messy. It's been complicated, it's been volatile, and to be honest, it's been pretty confusing for a lot of people. It was anything but a straight line up. So let's try and piece this puzzle together.
To really get why the reality was so messy, we first have to rewind and look at the simple promise. What was supposed to happen, according to the textbook? Well, the logic on paper is super straightforward. Lower rates mean cheaper mortgages when you're buying a home, cheaper loans for businesses that want to expand, even lower interest on your credit card. The whole idea is to get people and companies spending and investing again, which should boost profits and send stock prices soaring. That was the dream scenario.
But here's the thing. That dream scenario completely missed the first massive surprise, which was this huge rotation happening just underneath the surface of the market. While the big indexes like the S&P 500 looked kind of choppy, a ton of money was actually on the move.
See, for the past couple of years, while rates were super high, investors all piled into the same lifeboat, a handful of giant, cash-rich big tech companies. They were seen as safe. But the second the Fed pivoted, that entire trade got flipped on its head. Investors started cashing out of those crowded tech names and went hunting for bargains in sectors that had been crushed by high rates. So where did the money go? It flooded into these suddenly attractive, kind of boring sectors. Utilities, which always carry a lot of debt, suddenly saw their borrowing costs go down. And they got this wild, unexpected tailwind from the insane power demands of AI. Real estate and financials, two sectors that are super sensitive to interest rates, also saw a huge wave of new investment. And hey, it wasn't just the big players. Smaller companies, the ones in the Russell 2000 index, they got an immediate shot in the arm. A lot of these smaller businesses rely on loans with variable interest rates. So when the Fed cuts, their monthly loan payments get cheaper, like overnight. It's an instant boost to their bottom line. Okay, so that covers the Great Rotation, but it still doesn't explain why the overall market reaction just felt so blah when the official news finally broke. And that brings us to the next absolutely crucial point. The market never, ever waits for the news.
This timeline really tells the story. The market is always trying to look into the future. So all through the middle of 2025, when all the signs were pointing to a Fed pivot, the market was already rallying. It was pricing in the good news months in advance. So by the time the Fed made the official announcement in September, it was old news. And that led to a flat reaction and a lot of volatility as investors basically said, okay, what's next?
The lesson here is pretty simple, and it's a tough one for a lot of people. If you waited for the official announcement from the Fed, you basically missed the party. The market had already celebrated, popped the champagne, and moved on, all in a classic case of buy the rumor, sell the news. All right, so now we get to what might be the biggest twist in this entire story of 2025. Something that happened in the bond market that really, really caught people off guard. This whole twist centers on a really important number, the 10-year Treasury yields. Just think of it as the bedrock interest rate for the whole economy. And most importantly, for a lot of us, it's the number that basically sets the price for a 30-year fixed mortgage. And just like with stocks, there's a textbook rule here too. When the Fed cuts its short-term rate, this big, important 10-year yield is supposed to fall right down along with it. Cheaper rates from the Fed are supposed to mean cheaper rates for pretty much everything else. But this time, it just didn't happen. The 10-year yield stayed stubbornly high. So why? Well, the bond market was looking at other things. It was worried about inflation being sticky, the economic hit from new trade tariffs, and the fact that the government was still spending a ton of money. The bond market was basically saying to the Fed, hey, thanks for the rate cut, but we still see some risks out here. And this is where it hits home for Main Street, because those stubborn bond yields meant that mortgage rates didn't come crashing down like everyone hoped they would. Sure, they fell a little bit, but not nearly enough to really fire up the housing market. It was a real-world consequence of a really complex market surprise. So we've got this messy picture, right?
A huge rotation under the surface, a sell-to news event that fizzled, and these weirdly stubborn bond yields. What in the world does it all mean for the economy as we head into 2026?
And here is the big reveal, the twist at the end of the movie. All of this complexity, all this messiness, it's actually good news. It's probably the clearest signal we've gotten that the Fed has actually managed to pull off that mythical, elusive, soft landing, taming inflation without sending the economy into a recession.
Let's just break down the signs here. First, the Fed didn't cut rates because they were panicking. They cut because inflation was cooling off and the job market was normalizing gently, not collapsing. Second, these cuts are acting more like a soft cushion for the economy, not some emergency life raft. And third, we're seeing the credit market start to thaw, letting businesses borrow and invest again. It really is a picture of stability, not crisis. So where does that leave us? Well, the market is now basically in phase 2, watching for which of these two paths we're going to head down. Path 1, the economy stays strong, which means the Fed cuts rates really slowly. That could be a problem for those high stock prices. Path 2, unemployment starts to tick up. The Fed would have to cut rates faster, which is great for bonds, but it might signal recession fears for the stock market.
So the big takeaway from all of this is pretty clear. The old playbook, the one where you just bought big tech and watched it go up, that's probably over. The Fed's pivot has totally changed the game, rewarding those boring sectors like utilities, financials, and small caps. And as we move into this next phase, the real question for every investor out there is your portfolio ready for this new reality?